Time for a little education. Welcome back to the Dean's List. Today, we're diving into several topics that get everybody talking. The first of which is inflation. What is inflation? At its simplest, inflation is the rate at which the general level of prices for goods and services goes up, right? It erodes purchasing power over time. Right? That's what all of us hate. Now, economists often explain inflation as a natural outcome of a growing economy. When people have more money to spend and demand for goods and services increases, prices go up, right? That's the market system. Now, central banks like the Federal Reserve, they aim for a small controlled amount of inflation. They prefer something on the order of 2% annually. Why is that? Well, it encourages spending and investment, helping to keep the economy humming. So, why don't we see rampant inflation before COVID, despite years of low interest rates and asset purchases by central banks like the Fed? Well, the answer is complicated and lies in how that money was distributed. Pre-COVID, the Fed and other central banks injected liquidity into the financial system, mainly through quantitative easing, QE, and lowering interest rates. Now, this flooded banks and financial institutions with cash, which often found its way into stocks, real estate, and other financial assets. And that mostly contributed to the asset inflation you saw in your home and in your stock portfolio. So if you wondered why the stock market kept hitting new highs while wage growth and prices for everyday goods stayed relatively steady, that's why. The money wasn't being put directly into the hands of consumers. It was circulating primarily in the financial sector. Now enter COVID-19 and a major shift. The government didn't just ease monetary policy. It handed out stimulus checks and threw helicopter money, right? Expanded unemployment benefits, direct financial support to households, and those programs for businesses like PPP and EIDL, right? Money literally fell out of helicopters into the hands of the man or woman on the street. And for the first time in modern history, we saw massive fiscal policy working hand in hand with monetary policy in a way that put money directly into people's pockets. This was different from quantitative easing, mostly propped up asset prices. Now, there's suddenly an influx of consumer spending power at a time when global supply chains were severely disrupted. The result, a perfect storm for consumer price inflation. So why is inflation good? Controlled inflation, like the kind we seem to be returning to right now, drop some comments if you disagree, is a sign of economic health. Prices rise gradually, consumers and businesses are motivated to spend and invest sooner rather than later. You understand, it acts like a little kick in the butt, right? Go out there and spend that money, because if you don't, it's going to lose its value. And that supports a growing economy. Moderate inflation can also ease the burden of debt. If you have a loan at a fixed interest rate for your home or your car, inflation effectively reduces the real value of what you owe over time, making it easier to pay off. And this is one of the keys to why real estate investors that hold for 20, 30, 40, and 50 years are some of the wealthiest billionaires on the planet. They love debt. Now, here's the catch. Why is inflation also a bad thing? Because when it gets out of control like it did in 2022, it reduces our purchasing power, and it reduces it quickly, like a shock to the system. Now, wages often struggle to keep up with rapid price increases, and that puts a squeeze on household budgets. High inflation can erode savings, as the money you set aside today won't buy as much tomorrow. For retirees on fixed incomes, this is horrible. They can be particularly damaged, and it makes future financial planning much more uncertain. Businesses are seeing materials costs and labor costs rise at the same time and can't adjust prices quickly enough, right? That's why in 2022, Cardiff saw so many small business defaults. Now, let's take a step back and consider the broader picture. Why do older folks reminisce so much about lower prices from their childhoods? It's not just nostalgia. It's a reflection of how purchasing power has changed over decades. $1 in the 60s had a lot more value than $1 today. And some of this shift is expected. Due to natural inflation, periods of high inflation like the 70s and 80s, those times leave a lasting impression on those who lived through them. And the memories serve as a reminder of how important it is to protect each other from inflation through smart investing, right? That's our only shield from rising prices, is to be in assets that either keep up with or beat inflation. So understanding inflation helps us become better investors and savers. Stocks, real estate, and commodities should all outperform cash in the long run because they can appreciate at a rate that matches or exceeds that inflation rate. Do you think today's inflation concerns are overblown, or are we heading for a repeat of 2022? I want to hear from you. Get in the comments. What strategies are you using to protect your finances from inflation? Drop your thoughts. And if you found this statement helpful, remember, like, subscribe, and share helps us out tremendous amounts. Thank you for tuning in as we tackle the big questions so you don't have to. See you in segment 2, where we talk about central banks and the gold standard.